Welcome back. Today, I'm going to go over the mortgage rates volatility throughout this past year. Not only that, what are the impacts of a federal rates cut by the Federal Reserve impacts the mortgage rates, if at all? So with that in mind, let me go ahead and share my information. Here's the most current update. As you can see, mortgage rates jumped abruptly higher after the Fed's rate cut. Now, before I go over this particular article, let's go over the sudden jump of the 30-year fixed rate according to the Mortgage News Daily. As you can see, the 30-year fix for people with very good credit, around 720 or higher in the FICO score, according to Mortgage News Daily, as of yesterday, was 7.13%, which is pretty depressing. However, the 30-year VA rate is, as always, a little bit lower at 6.45%. And the FHA mortgage rate, 30 fixed rate is 6.42%. But let's go over the volatility of the 30-year fixed rate mortgage in the past, throughout this year, 2024. So we began the year in January 2024, according to the Mortgage News Daily, at 6.64%. Then we fast forward to April 28, 2024, it went back up to 7.45%. Then since June, we have a pretty much a steady decline in mortgage rate all the way until September the 12th, when the Mortgage News Daily shows 6.14%. A lot of us are thinking, wow, the mortgage rate is finally fall low 6%, maybe even to the high 5%. And pandemonium, right? It'll trigger tremendous amount of activities of refinance and people submitting mortgage applications. It did for a short while, but this is such a teaser. They teased us. This 6.14 mortgage rate is a very short lived, as you can see. Then immediately thereafter, then a month later, October the 4th, it went all the way up to 6.53%. Then November the 6th, this year went all the way up to 7.13%. And then down to the December the 6th, went down to 6.68%. And then finally, as of yesterday, December the 18th, 2024, went all the way back up to 7.13%. So it's all about volatility. Then as you cut through this article right here, mortgage rate jumped abruptly higher after the federal rate cut. And the Jerome Powell cut the rate 0.25 basis point yesterday, December the 18th. According to the first paragraph, if anyone needed any further convincing that a federal rate cut is no guarantee of mortgage rate, today's is a great piece of evidence. The top tier conventional 30-year fixed rate mortgage went back to over 7% for the average lender. So again, the mortgage rate spike have nothing to do with the federal rate cut. The rate cut is only a small part of the information released by the Fed today. Let's dive through some important highlights. In a widely anticipated move, the Federal Reserve on Wednesday, December 18th, lowered its benchmark interest rate by 25 basis points, bringing the target range to 4.25 to 4.5%. This is not mortgage rate. This marks a third consecutive reduction by the Fed following a 50 basis point cut in September. As you recall, back in September, everybody thought this drastic rate cut will cause the mortgage rate to come down. It did not go down back in September. It went up, as you saw from the previous example. And then another 25 basis cut in November last month, cumulatively reducing by 100 basis points this year. Going forward, however, a slower path for rate cut is expected when compared to previous forecasts from the Fed policymakers. What's happening is in 2025, expect only, again, that's a projection based on all these trends that the Fed will cut the rate 2 times this coming year. Previously, you might have heard that it is predicted the Fed will, in 2025, will do like 4 rate cut. Recent indicators suggest that economic activity has continued to expand at a solid pace, according to the Federal Open Market Committee, FOMC, said in a statement. So it's all about the labor market, right? A more cautious approach of Fed monetary easing will keep borrowing costs higher for longer across the economy. This includes the mortgage rate, which are benchmarked to the 10-year Treasury yield. The mortgage rate goes up and down based on the 10-year Treasury yield, or not based directly from the federal rate cut that we've been seeing. 10-year Treasury yields are expected to fall to the mid to low 6% range by the end of next year, by the end of 2025. A drop in mortgage rates could potentially revitalize the housing market. The Fed's gradual approach to easing means many homeowners will likely remain locked into their favorable rates, prolonging the market's stagnation, according to this economist from First American, Sam Williamson. The labor market is strong, the economy is strong, therefore the 10-year Treasury rate will remain elevated, causing the mortgage rate to be elevated as well. So any one of you are thinking like we could have a mortgage rate in 2025 around 5%, you're in for a rude awakening. According to my estimation, no one have a crystal ball, but mortgage rate, according to many sources, will remain elevated to around the mid 6% to low 6% throughout 2025. Around 2026, the 30-year fixed rate mortgage may come down below 6%, but that's further down the road. Again, it's all based on inflation. It's all based on the labor market. The unemployment rate is very strong. If the economy is very strong, the labor market is very strong, you're not going to have a mortgage lower rate because, again, the federal funds rate at the 10-year Treasury are dictated by the labor market. So we have a strong economy. The labor market is very strong. The unemployment rate is very low. You can continue to have an elevated mortgage rate for the foreseeable future. Eric Orenstein, senior director at Fitch Ratings, said in a statement that the inflation risk have kept Treasury yields higher even with the Fed's third consecutive rate cut. Through mortgage originators will benefit from higher volume in 2025 with nearly 2 million of outstanding mortgages above 6%. So here's the bottom line. This is a new normal, meaning the consumers out there are expecting the mid 6%. They've been burnt. We've been burnt, right, as consumers, as potential home buyers out there, that waiting too long, waiting on the sidelines for 5% or even a 4% mortgage rate. That's not happening. So people accept the new normal, which is mid 6%, maybe low 6% moving toward 2025. People are tired of waiting for the past 2 years in 23 and 2024. They're tired of waiting on the sidelines. Consumers, prospective home buyers, they want to move on with their lives. They really want to buy a home. It's the American dream. So they understand the mortgage rate volatility, but a lot of those people are going to take action, especially in spring 2025. We believe there will be more sales, more transactions in spite of the elevated mortgage rate. It will be another normal sales transaction year for 2025, similar to 2024. There will be more demand. There are still more demand and supply of homes, right? Nationwide. So people going to get off the sidelines, and especially in around March and April 2025, the spring selling season, and they're going to start buying homes, even though a lot of people are locked out of the affordability, even though a lot of homeowners are locked into the low mortgage rate, they're not going to sell. So anyway, so things will be stabilized. Who knows if the mortgage rate all of a sudden comes low 6% or high 5% in 2025, you know what's going to happen? The dam is going to break. We're going to see a surge. We could see a pandemonium of activities of demand. So demand is still greater than supply. So a lot of people are tired of waiting. They can take action regardless of the mortgage rate volatility. If you receive any value from this video whatsoever, please like and subscribe my channel. Make a comment below. What do you think about how the mortgage rate can affect your situation? Where are you located? Are you in your local market doing well? What is your goals and objectives? You think the mortgage rate going to come down below 6%? You think there'll be a pandemonium of demand of buyers getting off the sidelines to buy houses? So share us your thought. Thank you so much. This is Seewing Yee, and I will see you on the next video. Have a nice day. Bye-bye.